Good evening. Come to this wonderful chapter that is called private equity. Okay. Now we are understanding some important terms in the business of private equity. So yesterday you have seen leverage buyout, management buyout, hurdle rate, etc. Now one important term, paid in capital, but this is very easy. You are a student of accounts. Paid in capital means whatever amount the investors have paid. That is paid in capital. In your accounts you used to write authorized, it is not authorized. Issued, it is not issued. Subscribed, it is not subscribed. Paid up capital. So that is paid up capital is the amount of capital contributed by the investor. It is the amount of capital paid in by the investor during the issue of equity share. Actual amount paid by the investor, including the par value of the shares themselves. Paid in capital represents the funds raised by the business from equity and not from the ongoing operation. So this is direct addition in the equity of the company. It is not a profit of the company. But nowadays income tax department, they have gone mad. They are saying that in case if you raise more than fair value of the share, excess amount will be treated as income of the company. Again some cause of dispute now in the India. Already we are overburdened. What is fair value? Nobody knows actually. Okay. So you will not write any such thing, but in India we find ways and means to create disputes. India is a land of dispute. Paid up capital is shown in the equity section in the balance sheet. It represents the amount of money shareholders have paid into the company by purchasing the shares. It is basically involves two accounts, par value of the share and excess over par value. The excess over par value in India we call it securities premium. Okay. Now this was not very important, paid in capital, but the important thing is term sheet. Term sheet means it is basically terms and condition. Whenever the venture capitalist or the private equity investor and this businessman, they have to enter into an agreement, first they will sign a term sheet. What is term sheet? As the name suggests, sheet containing terms and condition. So both parties should know what they can expect from each other. What are their rights and obligations? So they can ask you a question on term sheet. So what is a term sheet? A term sheet is an agreement copy. A term sheet is an agreement copy that the VC hands over to the management. The venture capitalist and the management, they sign this agreement. What does it contain? So term sheet will contain the terms and conditions. Fee structure. How much venture capitalist will charge? They charge fees also. Then payout terms, okay, dividend, etc. Or liquidation rights, which we'll discuss later. Anti-dilution provision, again we'll discuss later. Preemptive right, exit terms, etc. This list is not exhaustive. Depending upon the type of business, situation, law of the country, accordingly they will put things in the term sheet. So it's basically like a agreement copy where most probably all details are mentioned, so that later on you have a term sheet you can refer to understand the rights and interests of the party. In case of dispute, you can refer it and go to the court also. Another question they can ask in the exam, what are the critical terms that appear in a term sheet? So one is the fee structure. A venture capitalist is putting his money in a risky venture. Yes or no? So he wants some fees, some return. The VC will have two types of fee income it earns. A management fees, that is based on a fixed percentage, and a carry. What is carry? We will discuss. It is like a share in the profit. Okay. Fees and carry. Management fees will vary from 1% to as high as 5%. The normal standard being 2% of the total invested funds in the venture. So what is the range of fees? 1 to 5%. But on an average it has been observed that generally it is 2%. It is not unusual to find a tapering clause in the fee structure after a specific period, say 3 years, post which the fee percentage starts shrinking to the harvest year. So there can be a clause like this also. It's all negotiable. Remember, fees can be 5% in the beginning, then slowly and slowly they may reduce the fees to 1%. And what is the meaning of harvest year? The year projected to be exit year for the PE or VC. Harvest, this word harvest is used in farming. Once your crop is ready, then you harvest it, remove it. The life of the crop is over. Okay. So here when the exit year is called harvest year. Underline or write down. Actually this is printed in point number 2 below. In case if you don't want to write, you are a lazy fellow like me, you can just read below harvest year. One person is not writing, he says, sir, it is written below. You are right. So fees can reduce, and maybe slowly and slowly it may become zero also if you reach the harvest year or the exit year. And then note on carry. What is carry? Carry clause would mean a carried interest in the profit of the venture, either for a certain predetermined number of years or till harvest. So they get a share in the profit also. Over and above what is there, that yesterday we saw hurdle rate or target return. The GP, who is GP? General partner. LP, limited partner, usually stands to earn a portion of both management fees as well as carry, because he takes all the efforts to create a PE, invest, manage. So he gets fees plus carry, and limited partners don't receive the fees. Carried interest gets payable after the hurdle rate is achieved. What is the meaning of harvest year? The year projected to be exit year for the PE. PE means private equity or VC. Normally this type of arrangement like private equity, venture capital have a exit year, because they will not remain with you for say ever. They will be there for as long as they earn a high return, and after 5 years or 10 years they would like to withdraw from the company, because now the company only gives the normal return. They will take that money out and put it in some other profitable venture. Now what is down round? Take mark, down round. On your own you can't guess in the exam. You have to come to this page. This would mean the investor pay a lower price per share than what the previous investors paid. Down round. This is share market or this is security market. The first investor paid 10 rupees per share. The second investor may pay 9 rupees per share. Second round of funding, 9 rupees. First round of funding, you raise 10. So who would be the loser in this case? The first round investor, because now his value will also fall, which indirectly implies that the investors have valued the VC at a lower value in the current round than the previous round. So when the value is reduced in the next round, subsequent round, it is called down round. This decline is called down round. For example, if the initial round of funding earned rupees 1 crore for an equity, in the first round there is 1 crore, in the round 2 obtained a value of rupees 0.7 lakh, my God, there seems to be some inconsistency. From 1 crore it has directly become 0.7 lakh means 70,000 rupees. Maybe it should be 0.7 CR, okay. Anyway, that does not affect my discussion. Value has gone down. First round for the same stake, 1 crore rupees. For the second round, 0.70 crore. This means that the investors have valued the entity lower in the second round, causing a down round. Down round causes a dilutive effect of original investors' right. Its value goes down. Method for computing anti-dilution right. Now what they can do, they can put some kind of clause to protect the interest of the earlier investors. Let us see how do they do it. To avoid a possible dilution to a down round situation, because VCs don't want to lose their money, so they may negotiate this point. To avoid a possible dilution to a down round situation, the term sheet will contain an anti-dilutive clause. It might include anti-dilutive clause. This is achieved either by a full ratchet method or a weighted average method, and the preferred method is mentioned in the term sheet. So let us see how do they do it in one example printed below. In a rare case where it is not explicitly stated, weighted average method is usually adopted. So dear student, in order to understand this full ratchet method or a weighted average method, let us come to one small example. Is it printed in your book? Illustrative example on application of anti-dilutive clause. You don't have to write, understand. In order to protect the interest of the first round investor, Series A investor, they may have an anti-dilutive clause also. The position of holding in a VC before the second round is as follows. Before second round, this is the first round, the promoter is holding 6 lakh share and the Series A investor means venture capitalist who initially invested 4 lakh shares. So total number of shares 10 lakh. Per share value is 1 rupee, 1 rupee, 1 rupee. Value of the promoter 6 lakh, value of the Series A investor 4 lakh, total 10 lakh. Percentage holding 60, 40, 100. No problem. Now in Series B, it happens in practical. Once you need more money, you invite more investor. Series B, an investor has given a down round value of only rupees 6 lakh. So he has given the value of this company. How much is the value he has given to this company? Only 6 lakh rupees. Okay. He takes 5 lakh share from the shareholder. Let us understand again. 6 lakh and 4 lakh. You have invited a new investor. So now their stakeholding will be 3 lakh, 2 lakh, and this is given by Series B investor now 5 lakh. But this fellow says the value of this share is only 0.60 now. Why 0.60? Because the total value of the company is now 6 lakh rupees. Total value of the company is 6 lakh, which means per share value will be 0.60. So value of the other investors will also fall. Value of the other investor will also fall. 1,80,000, 1,20,000, 3 lakh. Earlier it was, if you see the previous table, it was how much? It was at the rate of 1 rupee per share. So now it is at the rate of 60 paise. So if you look at this investor, he has suffered in terms of value. So Series A investor will not be happy with this kind of arrangement because he is a venture capitalist. He is not there to suffer the loss. At least some protection should be given. Some anti-dilution clause should be there for protection of Series A investor. So you would note that the share of Series A investor has gone down, whereas the late entrant Series B investor has an upper hand. Now say if there was an anti-dilutive clause, that table was without anti-dilutive clause, which stated to protect Series A investor against a down round, the revised sheet would look as follows. What will be the revised sheet now? Total number of share 10 lakh. But he will continue to hold 4 lakh share. If you look at the previous table, both parties had given amount or the shares to Series B. But Series A investor will now not be parting with his share. But the original promoter will have to give the share. So now the stakeholding will become 1 lakh, 4 lakh, 5 lakh. Okay. Common stock, that means original promoter has given stake to these shareholders now. That 5 lakh has been reduced from common stock and transferred to Series B investor. Total value of the company is 6 lakh. So now the value of your original investors, that is promoter, will be 60,000. Series A investor is 2,40,000 and Series B investor will be 3 lakh. Their stake, that is Series A investor stake, will be maintained. Of course, value cannot be maintained. Value has reduced. That much loss you have to suffer. But at least what we ensured, your stake in terms of percentage will be the same. Value will go down, otherwise what is the use of venture capital? But if you compare this table with the previous table, in the previous table his value was how much? 1,20,000. Now it is 2,40,000. Is it there 1,20,000? It is 2,40,000. And his stake was earlier 20%. Now he is holding 40%. So this is called anti-dilutive clause. At least to this extent he is protected. What is an up round? Reverse. Mostly it is in practice up round, but who knows? Future is uncertain, so it can be down round. It means the value received in the second round or subsequent round is more than the value received in the previous round. So the opposite of down round, where the successive round of investment has valued the venture at a value higher than the earlier round. Next is break fee. What is break fee? A fee typically payable to the investor if the company declines the investment described in the term sheet, or if the company or founders breach exclusivity or other binding provisions in the term sheet. So these fees will be payable to either PE or VC if the company declines the investment described in the term sheet. That is, they are not given the share that they were promised. Okay. Like we have promised to give them 40% share. Maybe the company have not transferred this 40%. So that means you are violating the term sheet provision. So in case if you violate the term sheet provision, you will have to pay them a fees, that is called break fees. Or sometime there is a exclusivity condition. What is exclusivity? You will not invite other investors. Because if you invite other investor, you have seen in the previous example, the stake of the venture capitalist may go down. So in case the company or the founder breach exclusivity, then you pay the break fees. Or in case if any other provision in the term sheet has not been followed, then you have to pay the break fees. So it's like a penalty for not observing the term sheet. Then your question will be, what is exclusivity arrangement? Exclusivity arrangement means a kind of non-compete period during which the company cannot negotiate for investment with outsiders for additional investment in the company. Okay. So when the VCs come to your company, they may also put a condition: you are not going to raise funds from other investors because their stake will go down. Is it right? So during which the company cannot negotiate for investment with outsiders for additional investment in the company. See, everybody wants a bigger pie in the cake, and therefore they would put the exclusivity arrangement. This is to protect the holding rights of the PE. So these are some important points in term sheet. Now come to cost of investment in private equity. Cost of investing in private equity. The cost of investment for a private equity will economically be the same as seen for a VC, barring for the capital cost in the specific cases. Given that the Ps are strategic equity holders, they would always prefer to hold the investment using a holding subsidiary company structure. So what these Ps normally prefer, that P will be the holding company and the other entity will be a subsidiary, or sometime through subsidiary they acquire the investment. But these are very general statements, case to case basis. It depends how much stake you get. If you get 30% stake only, you can't become a holding subsidiary structure. We will see the valuation, how to compute the amount. They do the valuation, okay, of shares. This would help to exercise control from outside. But this line is only applicable if you get the control. Institute has written the note assuming that they always get the control. Practically, you don't get always the control. Nowadays, the entrepreneurs are smart. They will not give you the control. So, assuming that they get the control, this would help them to exercise the control from outside without involving in the day-to-day operations of the subsidiary, as well as in maintaining arm's length, as there can be more than one strategic investor also. As per Companies Act, extra knowledge which you already have. Companies Act 2013 says an holding company will enjoy a majority status if it has more than 50% of the total share capital of the company and exercises control over the composition of the or exercises control over the composition of board of directors. That was about cost of investing in private equity, not very important. Now one important paragraph on which there is a question also in one of the model test paper. What are the exit routes for a PE? What are the exit route? What do you mean by exit route? How to sell your stake and get your money back? Huh? And it should also, wherever possible, result into a high degree of profit also. But profit is something which you cannot guarantee. Future is uncertain. So at least you should know what are the exit routes that you can include. Very interesting thing. There are 4 ways to exit out of a P investment once the horizon period is met, or otherwise by management decision. So either the number of years you have agreed, that is your harvest period is over, or as per the management decision that yes, now it is time you can walk out. One which is very popular is IPO. This is where you make money. This is where you make money. Like Facebook investor made 30-40 times of their investment when the Facebook was listed on the stock exchange. Otherwise till that time nobody knew what is the value. Okay. So generally what this PE or VCs do, first they'll make the enterprise successful, make it profitable, continuous profitable for 3 to 4 years. And now once they understand that yes, this entity has a brand value, it has a future earning potential. Investors also know about this company. People are willing to now put money in this company. They will ask the management, please go to the public and raise money. And then in IPO, sometimes the share prices are listed at a very high amount. And then you make a lot of profit. This represents a highly successful exit strategy, riding on a strong business model. And then they have said the payback can be instantaneous. Instant. The moment the shares are listed, sell, get out, make profit through selling the own shares immediately on listing on the stock exchange. This is very best strategy, but if it is possible, IPO must be possible. Second is, you can sell your stake to another company. The share of P is acquired by a larger company, usually in the same line of business. Okay, so that is called strategic acquisition. A bigger company will acquire your stake. So Walmart may acquire, say, the stake of SoftBank in Flipkart. Is it right? That time also they made a huge amount of profit. Thus, a small IT company into a niche testing technology line may get acquired by a bigger IT company, which is often seen in India. So, small IT company which develops some kind of technology is usually acquired by a bigger company. They acquire the shares of the P investors or venture capital investor. Another world famous example is Instagram, your famous social media. I have never used it. How does it work? I don't know. Only photos and videos and all useless things are there. Useful is also there. Today I will download. Okay. That is the only thing left in my life now, to download Instagram. And this was acquired by Facebook for many crores of rupees, in rupees terms, millions of dollars. And those who must have invested in Instagram at the beginning, now they must be millionaire. Is it right? This is perhaps the most commonly used exit route and is usually a win-win situation for both the exiting investor as well as the management of the enterprise. And then secondary sale, investor PE exit by transferring its share to another PE. Previous one was strategic sale, which means you sell it to a very big company and that big company pays a huge amount of money to you. This is you transfer your share to another similar PE. Such an exchange is seen either when a larger PE finds value in the venture, thereby giving a sweetened deal to the smaller PE. Similar to the previous one only. But in previous one, a company in similar business acquired your company. Here another bigger PE acquires a stake of smaller PE, or where the business may require more money which is not in the capacity of the current equity fund. Sometimes you need more money. The existing PE may not provide, bigger PE may provide. So that bigger PE will come into picture now. And the fourth one, which is also a very correct way of exiting, repurchase by existing management, that is founder members. Initially founder member asked you to give money. Now the company has become successful. They also have made a lot of money. So they will purchase the stake of the PE company. So I took 40% from you. I had invested 60. So now I will repurchase that 40% from you. Many times this is mentioned in the term sheet also. Because you don't know whether after 10 years I will get a buyer or not. So then generally they put this in term sheet that after 10 years, that is the harvest year, if we don't find the buyer, our stake will be purchased by management. Sometime, first we'll give a choice to the existing management to buy our share. That is called preemptive right. And if the existing management do not want to buy our stake, then we are free to sell it to the outsiders. Preemptive right. First right to existing management. This is an ideal scenario where the founders get back to owning the majority stake in their entity. Founders will prefer this because their stake in the company goes up. And this is called golden handshake to the exiting PE. Golden handshake. Last time, please shake hand, tata, bye bye. Not to see you again. Okay. That is called golden handshake. This was the term used for voluntary retirement. Is it right? That the employee is given a lump sum amount, shake hand, tata, bye bye. Not to see you again. Here the P is given the same big amount, take money, tata. This is also sometimes referred to as management buyout. The stake of PE is acquired by the management. The exiting PE in rare cases also get to earn a trail fees for the next n years as may be mutually agreed to by the parties, usually a percentage of the earning before interest and tax or a multiple based terminal value. This might be written in the agreement that even after the exit, he will get some fees, some commission based on a certain percentage of earning before interest or tax, or maybe based on a certain multiple of terminal value. All this they put in the term sheet. See, in the beginning when you are in the need of money, you sign such terms and conditions. Even after he has left, he is extracting money from the business. You may laugh at it right now, but practically it happens. When you are in the need of money and you are sitting in front of all those big giants, whatever they say, you say, yes sir, yes sir. Okay. Later on, after 5 to 10 years, you realize what you have done. But that is possible. And these big companies, they pressurize you to sign all these terms so that they will get more and more money from you. They will extract more and money from you. Now, what is the last method to exit? Liquidation. Your favorite topic in that intermediate. Yes or no? You make a format, put some data in that. Okay. As per list each deficiency balance. Remember? But I found that chapter very boring. Because you have to draw such a big 3-page format first. This is the least preferred method of exit. Okay, where the investor leaves out at a cash loss on capital invested. Now this is least preferred and least utilized method also. Practically least found because it means the company will have to be liquidated. And this will be only in case where the company is a loss making company. So whatever loss you will take on your capital, take it, go away. What can be done? This is venture capital or PE where the losses can be there. This usually happens when the investor cannot take further losses or had made an overestimate of expected return, or a particular idea behind the venture has not really taken off or well received in the market. So he will ask the management, you close down the company, whatever money we can recover, let us recover and take a hit on our profit and loss account. The term sheet usually provides financial safeguards to the VC against the drastic losses. So that is liquidation. Yes. 5 methods of exit. IPO, strategic sale, secondary sale, then liquidation, then management buyout. Okay, that's good. So that was a question in the model test paper. Now valuation of private equity transaction. That means the whole SFM chapter of valuation is a part of your syllabus. But we are not going to solve questions right now. But one of the important areas in SFM right now is valuation, because so many companies want to raise money now. They have come out with ideas. Technologies have opened the door for innovation, okay, and coming out with some business ideas. But they need money. Students who have passed out from IIT, IIM, they don't have money in their pocket, but they want to start a business. But they need money. How much money should be paid to such people? For that you require valuers. Okay. So there are certain methodologies that are intrinsic to valuation exercise. In fact, I will suggest after becoming CA, you start a valuation office, okay? Only valuation, no audit, taxation, GST and ghuskhori in the income tax office. People will come to you and they will pay you any amount of money if you do a proper valuation. So, valuation includes pre-money and post-money valuation. As the name suggests, pre-money is the valuation of an enterprise before the investment. That is, at the early stage when you go to the VC, they will do the valuation of a company. Post-money is the valuation after the investment by the VC. For example, suppose a startup company has a share capital of 10,000 rupees. Number of equity share 10,000, face value 10 rupees. Here one X, a VC has shown interest to do an initial funding of rupees 4,000. He says, I am willing to acquire 40% share in the company and I am willing to pay you 4,000 rupees. For 40% stake, he is paying you 4,000 rupees. All numbers are just to simplify. So what is the pre-money valuation of this company? So how do this valuation be done? He is willing to pay you 4,000 rupees for 40% share. So what is the entity worth? 4,000 divided by 40%. Is it right? So if you read in the newspaper, Swiggy has been valued at $3.3 billion. Now how did they get this figure $3.3 billion? So they have sold say 30% stake, and for that 30% stake they got say $1 billion. So reverse working, 1 divided by 30%, that gives you the enterprise value. Okay. So that is pre-money valuation. The post-money valuation will be fully diluted impact on the equity, which will be computed using the following formula. So how to compute the post-money valuation? New investment amount. New investment amount means total share post investment divided by shares issued in the new investment. Let us take one example to demonstrate. There is a company whose pre-money valuation is first line, 1,000 share, face value 10,000. Existing shares are 10,000, new investment given 400 share at 10 rupees. Now, if this figure is different, then this answer could have also changed. But in this example, he is selling the additional share also at the same 10 rupees. So, total number of shares will become 1,400. Total valuation will be 14,000. Per share valuation is 10 rupees and the post money valuation will be 14,000. Is it simple arithmetic? The above illustration is a simplistic presentation, not simple. Simplistic representation of how pre and post money valuation works in mathematical terms. And this is how in the newspaper they say this company has been valued at 300 crore, $2 billion. This is the mathematics they use. Okay. In real life, the VC would perform a valuation based on due diligence and the value would either be at a premium or at a discount. VC have a team of experts who do the valuation of the company. Okay. Expert means people like you are only hired there and they will go to the company, meet the management, read the balance sheet, read the competitors' balance sheet, read the stock market, and after that they present a valuation report. Based on that, VC gives money to the promoters. Next point is ownership dilution. This point you understand. How does this entire business model works? This is your company. You are 100% owner right now. But then what happens? In order to raise money, you have to give some share to the VC. So your share gets down. In the next round, you have to give more share to VC. So your share further reduces. So from 100 it might become 60, and from 60 it might become say 40. So as you raise more and more money through VC and PE, you have to dilute your stake. Each additional investment from the VC will end up diluting the ownership control. Ultimately, this is a cake. If you invite somebody else, your share will go down. If you invite more, your share will further go down. But then you need money. What happened? We are not offering you any cake right now, Nalayak. In the above example, you had 10,000 share, you invited 4,000 more share. So now your stake in the company will become 10 by 14. Just take your calculator, 10 by 14. 0.7143. So 71.43%. So over a period of time, the promoter stake keeps on reducing, but at the same time, is able to get more and more money, value of the company increases, and when the value increases to a very large extent, he sells all his stakes, goes out, makes crores of rupees, and enjoys the life. Is it right? This is what this Bansal friends did. Okay, Bini Bansal and Sachin Bansal. Oh. He's starting another startup. Again, he'll make money like this. Okay. Because they will first increase the valuation. Valuation will increase. Even though their share will keep on reducing, but whatever is left after few rounds of valuation, this is worth more than several thousand crore rupees. Sell it, go out. Okay. But of course, this requires a lot of intelligence, hard work, and risk-taking abilities. They had been working in Amazon in USA. Then they copied that entire model, okay, and launched their own product in India. Yes or no? In India, we simply copy others, very useful. For example, Ola, copied from Uber. Oyo Rooms, copied from Airbnb. There is a company, very big company, Airbnb. That is, they give you rooms, okay, small rooms as per your convenience. If somebody has got extra home or extra flats, and he does not want to take the hassle of maintaining that, Airbnb is started in India. They will give it to you. They will take it from, they will maintain and they will pay you the rent. So you can book online any room in the world now. Whenever you are traveling, you don't worry. Go to Airbnb site, and according to your budget, there will be different types of room. You reach there, they will hand over the key to you, and then you stay. Once you go out, you keep the key in some place they will assign you, and just walk out. So anyway, if there is a further round of investment, the management control even will go below 50%. But they don't mind because they have made a lot of money now. Their remaining 30-40% stake is also worth now hundreds of crores of rupees. Anti-dilution clauses are mandated in the term sheet to help overcome this problem. The number of shares to be issued will be adjusted to maintain the ratio of the holding. But sometime they may put this anti-dilution clause. That is, our stake will not fall below a certain percentage. In that case, the shares will be issued in a particular ratio such that your stake is maintained. So that mathematical calculation you can do. Now, what is liquidity preference? What is liquidation preference? It is an important term associated with PE funding. This term provides preference to receive fund by VC over and above preferred and common stockholders in the event of liquidation or deemed liquidation. What is liquidation? You know, company will be closed down. Now, normally in case of liquidation, we have to pay in a certain sequence, which you have learnt in that intermediate accounts chapter. First you pay liquidation expenses, liquidator remuneration, secured loan, unsecured loan. Before that you have some preferential creditor actually. Yes or no? Then you get preference shareholder. If something is still remaining, equity shareholder. This is what I remember. But they may put a condition in the term sheet, before anything is paid to preference shareholder and equity shareholder, the VCs would be paid. The VCs would be paid. Okay? And you might have to accept that condition. Or deemed liquidation. Deemed liquidation means company may be said taken over by another company. So although it may be continuing, but now it is acquired by some other company. That is printed below, deemed liquidation. I will come to that, last paragraph 8. Next is Series A and Series B. This also you will read in the newspaper very often, in case if you read newspaper, that this company has received Series A round of funding. This company has received Series B round of funding. So that means again, first time when you receive money, Series A, Series B. So Series A will be the initial round of funding. Seed capital they pay initially just to bring the fixed asset and other thing in place. The serious money starts in Series A, where they give a good amount of money, where Series B are subsequent rounds of funding. That means if you want more money for expansion, to face the competition, again they will bring money, that is Series B, which are usually after the enterprise achieves certain predetermined milestones. Next is return on investment. The rate of return that enterprise would offer to the investor on the investment is ROI. What is terminal value? This word you have learnt in SFM. Value of an enterprise at the end of a period, at the end of say finite period or a certain number of years. So value of the enterprise that would be and the end of time frame of the investment cycle of the VC used at the time of acquisition or sale to a third party. So suppose we assume that VC would exit after 5 years. So terminal value means value at the end of 5th year. Okay. How it is calculated? One of the methods of calculation of value, this is usually calculated by enterprise value. Enterprise value divided by EBITDA. What is EBITDA? Earning before interest, depreciation, tax and amortization. This is a popular term they use in valuation. EV means enterprise value. Suppose EV by EBITDA is 5, which means the value of the company is 5 times of the earning before interest, tax, depreciation and amortization. So what they will do, they will estimate EBITDA or EBITDA, whatever, after 5 years. Say it is 20 crore. So what is the enterprise value or terminal value after 5 years? It will become 100 CR. And accordingly they will do the valuation of this stake or whatever they agree that you will pay me so much money after 5 years. So an exit multiple would be used, usually calculated on enterprise value that the VC has been expecting to obtain at the exit through sell-off. So when they do the valuation, they keep all this in mind, that after 5 years I will get 100 CR. This is one example. It can be P multiple also, earnings multiplied by a certain number, P multiple. It can be based on DCF model also. Estimate the present value of future cash flow from 6th year onward. Take the present value, that is called terminal value. Terminal value was explained to you in SFM business valuation chapter. Okay. So you can refer there also. Then now what is the meaning of tranches? Tranches simply means installment. The VC or P will not put all the money in one installment, because you don't need so much money at the very beginning only. If you give too much money in the hands of a person, he will waste it. Okay. True or false? Yes. If suppose your entire year's salary is given to you on the day of joining itself, let us say, so you would be not careful in managing that money, but they give you installments, 1 month, 1 month, 1 month. So that by the time you spend that money, then you get the next installment. So VCs will bring fund only on certain agreed milestones, and the funding is made in parts or tranches, means installments. What is deemed liquidation? Liquidation means the business is closed down. Here business is not closed down, but it may include change of control, it may include acquisition, it may include amalgamation, it may include sale of a company or sale of most of the asset to another company. Where did we hear this word deemed liquidation in our discussion? Deemed liquidation had come in the point number 3, liquidation preference. That is, VCs will get preference over existing preferred stock and equity shareholder. Okay. As mentioned above, deemed liquidation normally are considered trigger event for liquidity preferences. Liquidation preferences. So these are some important terms in the context of this VC, okay, and valuation. In the exam, they can ask you multiple choice question from this area. Now, how is a private equity fund structured? This they should have given at the beginning. Okay, wrong editing. So how a private equity fund is structured? Generally, the private equity fund have 2 types of partners: general partner, limited partner. And then these 2 also share the profit in a different way. Institute have copied this paragraph from some US notes, okay? Because in India, it may not exactly work in this way. This works in USA. The way they have presented the note, it is how in USA this works. India may have a different way of working. The term general partner and limited partners are generic to PE world and represent the way the stakeholders and the rights are structured within the PE. PE fund is structured as a liability partnership. PE fund is structured. So what is the general structure of a PE fund? Liability partnership. And then there is a general partner. Yesterday I had dictated this. General partner is the one who represents the PE firms in terms of raising the capital from a basket of pension fund, angel investor, people like you, high net worth individuals. He will start a PE, general partner, and then he will identify who are the people who can also bring money. So he will target pension funds. Pension funds have huge money. People keep on depositing their annuity every year or whatever annual amount they have to deposit. Or they will target this angel investor, retired rich people, okay, retired fund managers, or high net worth individuals. like you, they are invited as limited partners. They are invited as limited partners, and these investors are, and the limited partners are these investors who have invested with the GP. The GP acts like the investment or the fund manager because he takes all the decisions. Like in a partnership, he is an active partner, and these others are like sleeping partner. Suppose I have also invested in one PE firm. I don't do anything. Whatever they have to do, they do. Only I want my capital appreciation. Should be 25% CAGR, which so far has not been achieved. Okay, market is down nowadays. But anyway, it's a long-term fund. If they don't give me return in next 5 years, 25%, then I will sell those shares. The GP funds, GP acts like investment or fund managers and will formulate the investment portfolio. They decide where to invest. I don't interfere in their work. Only monthly I ask them the statement. The enterprise where the P will invest funds and also determine the capital commitment by the LPs. And they also decide how much you have to contribute to become the member of that PE fund. And the amount is generally very high. Okay, it goes into many lakhs and crores of rupees. Minimum investment size. So that only serious people and people who can take risk, who can invest funds for longer period, they would become member of PE funds. Okay. A PE looking to fund an enterprise into e-retailing, example, will have its GP approaching its pool of LPs and say if a couple of LPs agree to investing the sum required, then this becomes the capital committed from the LP's end. Suppose there is a general partner, he thinks that there is an opportunity to invest in the e-tailing. What is e-tailing? Retailing on e-commerce. What is this Amazon? It is a retailer on e-commerce platform. Now this is a big time business. So big business that in future actual retail shop will come to an end. Yes or no? Nowadays you will not find too many book stalls around you. Many book stalls have closed down, which were big names. People can purchase online, people can download. Nowadays there is a Audible also. Audible book. You just pay some 100 rupees in a month and you can listen to any number of books. You don't have to read also. You will become more lazy. As it is, you are so lazy. You don't have to take the trouble of reading also. And they read very slowly in a nice soft voice. Okay. You enjoy. So that is e-tailing. You ask other LPs also. Haji? Audit and law you want in Audible. That's a good idea. I will ask Amazon if they can upload our audit book on Audible. Then you don't have to even read also. Okay. I'll become partner with Amazon. Okay. I will keep your proposal or suggestion in mind. They will ask other limited partners, you also invest money, and then they will bring money and invest in that business. You people have given me a lot of ideas. I think some of them are implementable also. Like this Audible in audit book in Audible. One practical scenario will be that investments are not required in one go. It will be in tranches. But this PE fund, when you become a member, they will ask you to pay the amount in tranches, already discussed. And they also pay to the businessman in tranches. And like you have studied in that equity share issue chapter, if you don't pay the call money, your previous call money is either forfeited or they will charge you a huge interest till you pay that call money. Is it right? So hence there will be calls raised by the GP for fund request from the designated LPs. In order to understand this business, I invested some amount and now I am able to make out, because they had called me 4 times, pay 5 lakh, pay 10 lakhs. I said, wait, I don't carry so much money. Okay, but they will give you a time, 14 days, 15 days. They will tell you in advance only when the next tranche is going to come. So in June only they will say next tranche is going to come in September. And then you have to understand in September you have to pay, and they will also remind you few days before in September that now the time to make the payment has come, otherwise either your amount will be forfeited or you have to pay the interest, something like this. Okay. So you have to keep lot of money separately so that whenever the call comes, you have to pay them. Suppose if one of them does not honor the call, the GP normally has the right to forfeit the amount invested. Again, it will be mentioned in the agreement by the LP to that point of time unless the agreement specifically states otherwise. Which means if they don't want to forfeit, they will have to pay the interest for delayed payment, or allows for a replacement by another LP, or maybe you can transfer your rights to another LP who would purchase at a discount the existing shares. The GP will usually stand to earn through management fees. What is the interest of the GP? The person who is looking the PE fund, he gets a fees. He is like an AMC, because he is managing funds of 100 high net worth people, say 1000 crore rupees is managing. 2% also if he earns per year, so 2% of 1000 means 20 crore becomes his income. Okay. And they also charge incentive fees. That means if the capital appreciation is more than 15% in a year, they might even charge some incentive fees from that also. But you don't have time, you are Virat Kohli, VK, you earn crores of rupees. Invest through PE firms, enjoy the high return. Okay. So ultimately now the chapter is over. Conclusion. We have seen that venture capital funds and PEs fill in the capital requirement gap of new emerging technologies and innovation. So these are the benefit of PE firms. If PE firms or venture capital firms were not there, many innovations would not have become a reality. In matured market like US, PEs does play a significant role in funding such segments. In India, VCs and PE are still in evolving stages. Still lot of scope is available in India through e-commerce companies, though e-commerce companies have certainly progressed due to their innovative entry and exit strategies. Okay. VCs work towards short and medium term goals, whereas PEs stay put for a longer run. PEs invest for a very long term, whereas VCs would be normally only when it is high return they stay. Both have well defined exit strategies, typically through acquisitions or IPO modes. In India they come with the ambit of SEBI. So they have to get themselves registered with SEBI, and they have to follow the rules and procedure for equity sourcing and funding. This was about private equity and venture capital. The name of the topic should have been private equity, venture capital and angel investors. Okay. So this was an interesting topic. Now we will take a break.